Hello, good evening and welcome to this wonderful and amazing topic Schedule 3. So today we'll take some important questions on Schedule 3. All these questions have been asked either in the exam or RTP or MTB. So source is Institute's study material only. Any of these questions can again be repeated in your exam. So first come to question number 6. This question number 6. Following are the financial statement of JSP Limited. Balance sheet, share capital, reserve and surplus. This is the old format. And if a company is following Ind AS, then it can't start with equity and liabilities. It has to start with assets. Okay. So share capital, reserve, then we have non-current liabilities, long-term borrowing, deferred tax liability. See, there is a deferred tax liability appearing on liability side. Current liabilities, trade payable, short-term provision, other current liability, there is a note. So we'll have to read the notes also. Then asset side we have non-current asset, property, plant and equipment. Deferred tax asset is appearing on the asset side. Deferred tax liability is also appearing here on the liability side. So if the deferred tax asset and deferred tax liability arise under the same tax law, then they can be netted off in the balance sheet. So when we are going to prepare the answer under Schedule 3 Division 2, we will show net amount. Next line is inventory, trade receivable. Trade receivable also has a note here, we'll see. And this is your statement of profit and loss. Revenue from operation, expenses, employee benefit expense, operating cost, depreciation, total expense, profit before tax, tax expense, profit after tax. So P&L account is quite simple. Notes to account, now they have given you the breakup of reserve and surplus. Rupees in lakhs. We will also prepare the answer in rupees in lakhs. Capital reserve, surplus from P&L account, opening balance. So this will appear in statement of changes in equity, opening balance, opening balance. Current year profit we will recalculate. After some adjustment we will recalculate and then we will add in the SOCI. And there is a reserve for foreseeable loss. What is this? What is this? So we will see, there is a note below. Okay. So now come to next line, long-term borrowing. There is a note on long-term borrowing. Total loan from bank is 4860. Then we have deferred tax, unnecessary they have given because it's already appearing in the balance sheet. 300 and 100. We are going to present 200 deferred tax asset. Then notes to account. Notes to account, unclaimed dividend is 10. Unclaimed dividend will come in other financial liability, but billing in advance will come in other current liability. But they have mixed both of them under other current liabilities. So this I will have to change. Is it right? Then trade receivable, they have given you the breakup. Considered good outstanding within 6 months. Considered doubtful due from past 1 year. And provision for doubtful debt. So we have seen the disclosure requirement. You will also give the disclosure in a similar manner. Considered good, considered doubtful. Instead of writing provision for doubtful debt, we will write allowance for bad debts. Is it right? Then adjustments. Share capital comprise of 200 lakh share of rupees 10 each. So that is just for presentation. Then term loan from bank 4860 lakh includes interest accrued and due of rupees 860 lakh on the reporting date. So if you see your question, note number 2, term loan is 4860. Out of that, 4000 will come in non-current liability and 860 will come in current liabilities under the head financial liabilities, because amount is contractually payable in cash. Then next is reserve for foreseeable loss is created against a service contract due within 3 months. So this should come in provision. So we will remove from reserve. And put it under the head provision. So if you have note number 1 in the question, reserve and surplus, last item reserve for foreseeable loss, tick mark, that I will remove from there and I will put it under the head provision. So in the question balance sheet there is a short term provision, and in that short term provision we are going to add this provision for foreseeable loss also. Just by giving a name reserve does not mean it's a reserve, it's a provision for service contract. Then you are required to identify and report the errors and misstatement in the above extract wherever applicable. So this is really a test of understanding of a student. Can he identify what are the mistakes they have made? And after that you prepare the corrected balance sheet and statement of profit and loss. But the question itself has a big mistake. So 16 mark actual exam question, May 19. Is it written May 19 there? Yes. The question has a very serious mistake. What is that? Identify. The format is not as per division 2. But the question itself is not clear whether JSP Limited is an Ind AS compliant company or not. So somebody can say JSP is a non-Ind AS compliant company. In that case, the format is right, but some presentation can be wrong. But you are a final student. In final, division 2 is applicable. So we will assume in all question that the company complies with division 2. That is the underground assumption, that company complies with Ind AS 2. Otherwise balance sheet format is more or less right. You just have to change 1 or 2 numbers and institute will give you 16 marks for that. So to save your time, I have written what are the errors in the financial statement. First, before you read the answer, you try to identify what are the errors that you notice. What are the errors that you notice? Try to identify. Okay. One is the format, assuming that it is an Ind AS company. Second is that the DTA, DTL are shown separately, that we can set off. Then reserve for foreseeable loss should be shown in provision. Interest accrued should be shown in current liability. Then earning per share is not disclosed on the face of the P&L account. So we need to disclose the earning per share also. Then unclaimed dividend will come under financial liability. And billing in advance is okay, other current liability, but unclaimed dividend should be in financial liability. So these are the errors that they have made. So let us check the answer. This answer I have only prepared. First error is, in the bracket I have written assumption JSP Limited applies Ind AS. So the format and classification of item in financial statement are not as per Ind AS. Since company follows Ind AS, format should be as per division 2 of the schedule 3. This way you have to write in the exam. Second is EPS should be disclosed on the face of the statement of profit and loss. If you can calculate EPS, you should. Reserve for foreseeable loss is a provision for expected loss. It should be presented in current liabilities instead of reserve and surplus. hence it needs to be regrouped. So it will be removed from reserve and surplus and it will be added along with short term provision. Then we have discussed about interest accrued. Interest accrued will be shown in other financial liability under current liabilities, whereas the entity has shown it under the head term loan. Then DTA and DTL should be set off assuming that both are under same governing taxation laws. More about DTA, DTL we will discuss in subsequent chapter in days 12. What other thing you want to write?
Unclaimed dividend also.
Yes, write one more point. One more point, write down in your own good handwriting. Unclaimed dividend will be shown in other financial. In fact, in the interviews also nowadays they test your understanding of such presentation. So you have to really by heart the schedule 3, because if you join any company then they will ask you to do the finalization and you have to know which item will go where, because all this affects the ratios. Debt equity ratio gets affected, then current ratio gets affected, and because of which the decision of the users can change. So let us start now. So my policy will be same. We'll go line by line. Any item appearing in the balance sheet or P&L account or in the notes will have a single effect, and any adjustments given below will have double effect, right? So first item is share capital. Where do you think we should write it? SOCIE. Is the format drawn in your book?
Yes.
Mr. Pawar, good evening. Both Ajit Pawar and Sharad Pawar. Now, opening balance, write down 2000 here. Opening balance 2000 and write a small note here. Share capital comprise of 200 lakh shares of rupees 10 each. Then next item is reserve and surplus, note number 1. Go to in question note number 1. What is written there? Capital reserve. So do we have a column for capital reserve? Yes. Question is not clear whether it was opening balance or created in the current year. So what we will assume? Opening balance. And retained earning, opening balance 225. Okay. Can you give me the total of this 3 item? 2625. So one Miss Agarwal has also joined. Good evening. Then what about this current year profit of 1580? Should we write it now or we will write it later? Later, because we'll check. Sometimes the profit can change. So this is pending. 1580 is pending. And what about that reserve for foreseeable loss? Short term provision. Just check. Do we have a note on that? Note number 4. Yes, I have prepared a note. Maximum note you have to write, keeping in mind the time constraint. So write in this line, provision for expected loss will be 295. In the exam, try to write notes, but keeping in mind the time constraint. Next point is reserve and surplus we have done. Long term borrowing, note number 2. Total is 4860, but it contains 860 lakh interest accrued. So first I will come to balance sheet. Balance sheet. In balance sheet you come to liability side. Non-current liability, financial liability, borrowing, term loan. Here, how much will you write? 4,000. Sure. 4,000. You can write the calculation 4860 minus 860. And what do you do with that 860 which you have removed? Other financial liability, other note number 3, accrued interest. How much? 860. It seems we are solving intermediate type problem. Then deferred tax liability, note number 1 on the screen. In your book also note number 1. So where we will write deferred tax liability 100 in second line in bracket. Okay. Then we'll go to balance sheet. Question book should be in front of you. We are solving May 2019 question, 16 mark. In our book it is question number 6. Current liabilities, trade payable. Do we have any note on trade payable? No. So trade payable will come in balance sheet. Current liability, financial liability, trade payable. Directly write in the outer column 400. Then short term provision, we have a note. Note number 4. As per balance sheet, short term provision as per balance sheet given is 310. Then other current liability, note number 4. We have to read note number 4 in the question book, note number 4, where the breakup is given. Unclaimed dividend 10, which you will put in note number 3, other financial liability, unclaimed dividend 10. And that billing in advance, I'll come back to balance sheet. Last item, can you see last item, other current liability in bracket, right? Because you'll forget what is this. Billing in, either you prepare a note or you write here. 200 how much? 240. 240. Then I will come back to your question book, balance sheet. Asset side, property, plant, equipment. Do we have any adjustment? No. Asset side in our answer balance sheet, PPE 5600. Then deferred tax asset, we have a note number 1, 300. So net deferred tax asset is how much? 200. Come to balance sheet. Asset side, non-current asset. Deferred tax asset will always be non-current because it involves lot of judgment. Next point is inventory. Again, there is no adjustment in inventories. So can I write directly in current asset, point number A, inventory 1520. Then trade receivable, note number 5 of the question book. Note number 5, trade receivable. In our answer it is note number 2, trade receivable. So trade receivable, debtors secured, considered good 1565. Right here we are assuming that these are secured. Okay, debtors secured. Then you write debtors unsecured is not given. Then debtors with significant credit risk, doubtful is significant credit risk 253. And debtors impaired, we don't know. Allowance for bad debt 18. Although in the question enough details are not there, but this way you can write. Okay. This debtor secured, you write less than 6 months, because the aging analysis also you have to give. And this debtor significant credit risk is more than 1 year. that you can write. Aging you can write wherever aging is available. Now my next item in the balance sheet of the question is cash and bank balance. Do we have any adjustment in that? Cash and bank balance, where it will come? Current asset, financial asset. Under financial asset, cash and cash equivalent, is it there? 1200. This completes the given balance sheet. Now below that we have a P&L account. So we'll come to our main page, P&L account, revenue from operation 7500, total 7500. This P&L account is very easy. Employee benefit expense, in expense second line 1750. Then operating cost in expense first line 2860. Depreciation 800 because there is no adjustment. So we can take the total of expense, it will be the same 5410. Profit before tax 20, same answer. Tax expense, how much is given in the question? 510. Profit after tax 1580. Only one more thing I will add here, basic EPS. PAT is 1580, number of share 200 lakh share. So EPS in rupees will be how much? 7.90. In this question there is no other comprehensive income. There is no other comprehensive income. In some other question I will take that. And total comprehensive income 1580. This 1580 and this plus 0. So 1580. Is it right? Yes. So where will you transfer this 1580? In the statement of changes in equity, total comprehensive income, under the heading retained earning 1580, total 1580. And now let us check whether all the notes given in the question we have done or not. Just wait before we close. Reserve and surplus we have done. Long term borrowing we have done. Deferred tax we have done. Other current liabilities we have done. Trade receivable we have done. Additional information, share capital, term loan, reserve for foreseeable loss. All adjustments are done. So tell me the total of share capital 2000, capital reserve 400, retained earning 1805, total of the last column 4205. So I'll explain what you have to do. This 2000 will be written as share capital and the total of capital reserve and retained earning will be presented as other equity. Is it right? So come to balance sheet. Liability side, share capital, how much you said? Share capital 2000. Other equity 2205. You want to write the total in bracket 400 plus 1805. Later on you will not find this number in the answer, so it is better to write the working. This way you have to present very nicely, no shortcut. If you write like this, you will get full 16 marks. Now I think we have done. Just let us see all notes we have added. This trade receivable is not added. So what is the total of trade receivable? 1800. And other financial liability total 870. Then provision total 605. So let us transfer it to balance sheet. Trade receivable 1800. Then other financial liability total was how much? 870. Provision total was how much? 605. Yes, now we are done. Total of asset side, anybody? 10320. Very good. Total of liability side 10320. This way you have to write the answer in the exam. Minimum. More than that, if you can add, welcome. Okay. So notes you will have to write wherever you have more than one item. Wherever you have more than one item in a heading, you have to write a note. If there is only one item, either prepare a note or write directly in the balance sheet. Then I have given you some notes also for understanding. If you have time in the exam, then write these notes. Like unclaimed dividend is already adjusted. Since unclaimed dividend is appearing in the balance sheet, it means the entry has already been done. So no need to again deduct it in the SOCI, because these notes are based on queries which I received from the student. That why you have not deducted dividend from retained earning in SOCI. That we will do if I am doing the adjustment. Is it right? But here it is already done. Second is reserve for foreseeable loss is already given a second effect. It's appearing in the balance sheet. Means the entries have been done. We have only regrouped it. From one heading to another heading. The debit effect has already gone. So there is no need to again put it in the statement of profit and loss. Had it been given in the adjustment, then one effect will go to P&L account. Okay, at this stage of your life, I don't have to teach you such basic accounting. Same question student is asking, sir, why you have not shown interest in the P&L account? Interest accrued has already been accounted. Only instead of putting in the current liability, they have put in non-current liability. So I have only shifted the interest accrued from non-current portion to current portion. And if debtors are due from past year, still it will be current as the customer is not paying. Because some student had asked this wonderful question. It is written debtors are due past 1 year. Just because it is due past 1 year does not mean it is a non-current. He is not paying. But we are entitled to receive the amount at any time. So therefore it is still current. He is not paying. If we would have given him a credit of 3-4 years, then it will be non-current. He has to pay on a given date. He is not paying. It is current debtor. So such minute thing you have to understand. Last point is already explained. If the question is silent, the student is free to assume that DTA and DTL will arise under the same governing taxation laws. So are these notes required? These tutorial notes are not required in the exam. This is for the student. Based on the queries that we receive from the students, I have tried to compile the queries in the form of tutorial note, because these queries can come to you also. You may also be thinking why interest accrued, why provision for foreseeable loss is not shown in the P&L account, etc. Now we'll take the same problem with some additional adjustment, okay? Because institute is asking same question. This question is from MTP, October 2020, Corona year. Is it right? From the following financial statement of Abraham Limited, balance sheet, again they have given you old format. We have to assume that Abraham Limited falls under Ind AS. Share capital of rupees 10 each, means there are 100 lakh share. Reserve and surplus, note 1, almost similar problem. Long term borrowing, deferred tax liability. This time also you have deferred tax liability and deferred tax asset in the question. Almost same problem. Trade payable, short term provision, other current liabilities. Then non-current asset, PPE, deferred tax asset, tick mark, deferred tax asset, deferred tax liability. And then we have asset side, current asset, inventory, trade receivable, cash and bank. Revenue from operation, P&L account, expense, same 3 item, employee benefit, operating cost, depreciation, total expense, PBT, tax expense, PAT. Most of these MTP questions are just repetition of past exam, RTP and study material. Okay, they do not have any creativity left. Note number 1. Reserve and surplus, same 4-5 lines. Capital reserve, P&L account, opening balance, addition, reserve for foreseeable loss. Then long term borrowing, term loan from bank. Note 3, same, deferred tax asset, deferred tax liability, other current liability, unclaimed dividend. Then billing in advance, other current liabilities. Trade receivable considered good outstanding within 6 months, doubtful outstanding due past 1 year, and provision for doubtful debt. Same presentation. You have to write presentation nicely. Share capital consists of 100 lakh share of 10 each. Even if it was not given, it's already in the balance sheet. Term loan from bank 5700 lakh include interest accrued and due of 700 lakh as on the reporting date. Reserve for foreseeable losses created against a service contract due within 6 months. I am not explaining, it is same. But what they did as a creative thinker, they have added one more line. Inventory should be valued at cost 1500 lakh. NRV on the date is 1200 lakh. So which means the inventory figure needs to be reduced by 300 lakh. So we are going to reduce the inventory figure by 300 lakhs. A dividend of 10% was declared by the board of directors of the company. Declared by the board of directors. This question itself has an error. What is the date of declaration of dividend? What is the date of declaration of dividend? Is not given. If it was declared on or before the end of the year, then it is a liability. If it is declared after the balance sheet, then it is a liability of the next year. It will only be disclosed in that case. So we will assume that this was declared on or before the end of the financial year. So once it is declared, it is an interim dividend if it is declared before the end of the year. An interim dividend can be declared by the board and it needs to be provided for. It needs to be provided for. So this is a new adjustment for you. This we have to provide. This is not in the given balance sheet. So it will have double effect. One effect will be deduct from SOCI and second effect it will appear as a liability in the balance sheet, dividend payable. And then one more new adjustment, this time accrued interest income of rupees 300 lakh is not booked in the books of account. So this will have to record. Accrued interest income, one effect will be in P&L account, other income, one effect will be in financial asset, asset side, financial asset, current asset, financial asset, other financial asset. So these are the three new points in the question. Then what are we supposed to do? Then one more note, but that is already assumed. Deferred tax relates to tax on income are levied by the same governing tax law. So this time I don't have to dictate this to you. Identify and report the errors and misstatement in the above extract and prepare the corrected balance sheet and statement of profit and loss, and where required the relevant notes to the accounts with explanation thereof. Previous question plus 3 adjustment. This is 14 mark question in MTP. So first we will again discuss the same errors. First assumption is that Abraham Limited applies Ind AS. If Abraham Limited applies Ind AS, then the format used by Abraham Limited is as per the division 1, but they should follow division 2. The DTA DTL should be netted off. Third is EPS is not disclosed, which is to be disclosed on the face of the profit and loss. Accrued interest is shown in non-current liability along with term loan. It should be shown in current liability, financial liability, other financial liability. Reserve for foreseeable loss should not be shown in reserve, but it should be shown in current liability, short-term provision. So it will require regrouping. Inventory should be valued at cost or NRV, whichever is lower. They have valued it at cost. So we'll need to reduce the value of inventory, and that will reduce my profit also. Then accrued interest income of 300 lakh is not yet recorded. It needs to be recorded. Dividend declared is to be adjusted. So just complete this line. Dividend declared is to be adjusted, assuming dividend was declared on or before 31st March 2020 T20. And one more note we have to write, that unclaimed dividend should be shown in other financial liabilities. This way you can improve your answer. Write everything which is possible. So can we start in the same manner? Yes. Share capital, where do we write? SOCI, opening balance, share capital 1000. One note below, share capital comprise of rupees 100 lakhs shares of rupees 10 each. Then next line is reserve and surplus. In your question book, come to note number 1, question note number 1, and on the screen SOCI, capital reserve 500, retained earning opening balance 550, total in the last column 2050. Current year profit we will not write. Reserve for foreseeable loss, we will shift it to short term provision. Note number 4, just check in your book. Note number 4 is provision for foreseeable loss. Is it there? Right. How much is the amount? 400. Now I need to give you a warning. In the exam, before you go to the exam, you first practice in your own handwriting in a notebook, because right now you're able to solve easily. The challenge is in the exam visualizing the format. What are the notes required? So it takes time. So you need to do writing practice. Okay. And come back to your question. Liability side, there is a long term borrowing 5700. For that you read note 2 of the question. Note 2 of the question. Long term borrowing, term loan 5700, but there is another note below. Where is that note? Adjustment number 2, additional information point 2. Term loan from bank includes interest accrued and due 700 lakh on reporting date. So what I'll do, that 700 I will put in other financial liability, third line here, interest accrued on loan, how much? 700. And in balance sheet, liability side, non-current liability, financial liability, borrowing term loan, 5700 minus 700, 5000. Come back to your question book. Deferred tax liability is 400. We have a note number 2. Is it there, note number 2? Second line, less deferred tax liability. Just write 400 here. I'll come back to this. Don't change the sequence, okay? You can miss anything. Current liability, they have written trade payable, under that MSME and others. No adjustment, but you have to present separately on the balance sheet. So come to balance sheet on the screen. Balance sheet, liability side, trade payable. I think in your answer that breakup is not there. Write the breakup. I am sorry, but you have to do it. MSME others. MSME is how much? 5. And this others is how much? 295. 295. Just disclosure. Amount due to MSME will be shown separately. Now come to next item, short term provision. So we have a note number 4. Short term provision, note number 4. Provision given in balance sheet right here. How much? 300. 300. So what is the total provision? 700. This I can transfer to balance sheet. Liability side, last second item, provision 700. Okay. Then next item is other current liabilities. For that, go to note 4 of the question, and in that note 4 they have written unclaimed dividend. Where do we put it? Unclaimed dividend I'll put in other financial liability 10. This is already accounted, so this will not have any other effect. Billing in advance I will put in other current liabilities, note 5. Note 5, billing in advance 150, and other current liabilities in the same place 40. So what is the total? 19. So this I can transfer to balance sheet, other current liabilities. Other current liabilities, come to balance sheet, last item 19, and what was that note number? 5. Note number 5 write down if not written. Any query, please ask me. Any query? Back to your question. Asset side, property, plant, equipment, no adjustment, 5000. Deferred tax asset, we have a note number 2 in our answer. How much? 700. So deferred tax asset net will be 300. Back to balance sheet. Second line from the top. Balance sheet, asset side, deferred tax asset 700. And what was the note number? 2. So just correct it here. If it is written 1, make it 2. Match the note number, okay? Maybe I have just copied pasted the same format. 300. Wait, I'll rectify. It should be 300. Okay, now back to your question book. Inventory is 1500, but there is an adjustment. Adjustment number 4. Inventory should be valued at cost 1500 and RV on the date was 1200. Maybe there is a small drafting. The inventory has been valued at cost, but its NRV is 1200. So I will have to make 2 adjustments because this is outside the balance sheet. In balance sheet 1500 is written, but I have to reduce it to 1200. So what I'll do, balance sheet, where is inventory? Asset side, write 1200. So my profit will reduce by, they should have given in the question change in stock, so there I would have adjusted, but they have not given change in stock. So what I can do, I can reduce it from operating cost, or I can put it in exceptional item. Either of the two presentation will do. So we'll reduce it from operating cost. So decline in inventory, how much? 300. 1500 minus 1200. Sorry, wait. It will increase. Operating cost will increase because closing stock is reduced. So we'll add it. It's written also add. Now I'll come back to next item, trade receivable. There is a note on trade receivable. What is that note number? 5. Trade receivable. Debtors considered good. How much is good? 1065. In bracket write down less than 6 months. Then debtors which are credit impaired is 40. Due from past 1 year. Outstanding for more than 1 year. Due for more than 1 year. The users will understand that these debtors are now very risky and they are not going to pay. The company will incur losses. So what is the total? Total will be same, 1100. So I'll put this 1100 in the balance sheet, asset side, financial asset, trade receivable. Is it 1100? Yes. And what was that note number? 3. Note number 3. Question book again. Cash and cash equivalent 2000. Do we have any adjustment in that? No. So write down cash and cash equivalent 2000. Then I will come back to statement of profit and loss in the question, which has very limited adjustment. Revenue from operation, write down 6000. Revenue from operation 6000. Don't take total because one more item will come. Employee benefit expense, you write down 1200. Operating cost, there is a note number 1. Note number 1, operating cost given in the question 3199 plus 300 3499. Is it 3499? So I'll just put it in the P&L account. Operating cost 3499. Agreed. Then depreciation, no adjustment, 450. Wait, don't take total, just wait. And total expense I'll do later. PBT I'll take later. Tax expense, do we have adjustment in tax expense? Tax. But tax rate is not mentioned in the problem. So you are right, it will change because your income will change. But do we have any choice? Can I change your tax liability? The answer is no. So write down same 201. 201. Now you can't say, sir, can I take the question book PBT, tax expense, calculate the percentage? But you are a good student, you know that there are some disallowances, some deduction, exemption. So I can't do that, and just don't make complicated. The objective is not to test your tax knowledge. If tax rate was given, maybe we could have thought about it. We'll write assumption, don't worry. So tax expense we have written, PAT will take later, EPS later, OCI is not there. Dash. Now notes to account in question book. Note number 1, reserve and surplus we have done, long term borrowing done, deferred tax we have done, other current liabilities we have done, trade receivable we have discussed, Additional information, point 1 we have covered, point 2, point 3, point 4 we have done. Point 5 is pending. A dividend of 10% was declared by the board of directors of the company. So what is the effect you will give? One is you will deduct it from SOCIE. Third line I have written dividend payable from retained earning. How much? 10% of share capital. Dividend is calculated on share capital 100, total 100, and this you can put in bracket because I have to reduce. And what about the second effect? Dividend payable will be other financial liability. Second line here, dividend payable 100, total of other financial liability 810. So we'll go to the balance sheet liability side. Under that we have here other financial liability 810. What was the note number? 6. Okay, write 6. Okay, next adjustment. Accrued interest income of rupees 300 lakh is not booked in the books of the company. So income will increase and income receivable will appear in asset side. So on the screen, asset side, other financial asset, accrued interest 300, other financial, or you can make a note also, but as I said, if you have only one item, maybe you can write directly, institute will understand, because we have only 3 hours. In fact, I have made a video also on YouTube that FR paper timing should be increased to 6 hours as a negotiation, so that they will come down to 4.5 hours. Okay, so that the student can write comfortably, because time is not enough. So now write down in the P&L account also, interest accrued 300, other income. Last line, deferred tax relates to taxes on income governed by same tax law, we have done. So now my answer is almost ready. First you tell me total revenue. Just make a small correction, instead of total revenue, make it total income. In the amendment made in 2022, they said don't use total revenue, use the term total income. Anyway, just a name change, it won't affect answer. Total of the expenses, anybody? 5,1. Now you can tell me PBT. 11. PAT. EPS 950 divided by 100. 9.51. Total comprehensive income. Okay, 50. 9.50. Total comprehensive income PAT plus OCI. This is 950. So where will you put this 950? SOCI second line, total comprehensive income 950. Take vertical total, share capital, capital reserve, retained earning, total 2900. Okay. Any student, any query who are studying online? Any query? No queries. So what I'll do, I will go to balance sheet. Where is balance sheet? Share capital 1000. Other equity, you have to add these two numbers. So can you tell me what is the total of other equity? 1900. Now let us just check whether all notes we have transferred. Operating cost, deferred tax, trade receivable we have transferred. Provision, other current liability, other financial liability we have transferred. Okay. So now you can tell me the total of this asset side. 9900. And This side also tallied. Yes, 9900. This way student will write the answer in the exam. You will get full marks. Wherever possible, write notes. The moment you find more than one adjustments are there, you should prepare notes. See, everywhere at least 2 items are there. I have prepared the note. Even you can draw notes for one single item also. But as a student, you are given that much relaxation. So some notes I have written. Dividend is a confusing item. The student will have a doubt whether I need to record dividend or not. So I have written very clearly what you will do in different scenarios. So situation 1, if dividend is proposed, underline the word proposed, then only disclosure is required. Then it has not yet become a liability. But if dividend is declared, check the timing of declaration. If it is before the end of the year, which we have assumed in this question, then you will give one effect in SOCI, deduction from retained earning, and the other effect will be in current liability, other financial liability, because dividend is usually payable within 30 days after declared Then situation 3, dividend is declared after the year end, declared or proposed after the year end. It is liability of next year. So in this year, what I am going to do, I am going to give a disclosure that the company has either proposed or declared dividend at the rate of rupees say 3 per share or whatever. So it is a non-adjusting event. It is given in Ind AS 1, Ind AS 10 also, and the logic is it is not a liability unless it is declared by the end of the year. Liability will happen only after it is declared. So that was the note, and few more notes write down. Notes, tutorial notes. Decline in inventory value can alternatively be shown in exceptional item. Second note, write down, in the absence of information about tax rate, in the absence of information about tax rate, we have not adjusted current tax. We have not adjusted current tax. Okay. Question number 8. One more practice I'll do. Question number 8 has again got some extra adjustment, so I have to take it. This question number 8 was given in which exam? MTP August 18 for 16 marks. MTP August 18 for 16 mark, and similar question I think was asked in exam also, so I have taken only one of them, not both of them, because there is no point, except the figures it was 100% same. So schedule 3 question number 8 taken from MTP, also asked in the past exam. Following is the balance sheet or financial statement of Arish Limited, prepared on the basis of accounting standard. So this balance sheet is as per old format, which is not wrong if the company is following accounting standard. All figures are INR in million. Balance sheet as on 31st March 2018, equity and liability share capital share of rupees 10 each. So 1000 means 100 lakh share. Reserve and surplus, note 1, equity and liability, non-current liabilities, long-term borrowing, deferred tax liability, tick mark, current liabilities, trade payable, short-term provision, other current liabilities, same problem. Only they change few adjustments. Then they have used the term fixed asset here. Can you see fixed asset? Fixed asset we don't use anymore. We use the term PPE, property, plant and equipment. Deferred tax asset, tick mark, we have to show net amount. We'll see which figure is higher. Then inventory, trade receivable, cash and bank. Now this time they have given you two very interesting adjustment, and that is why I have to explain this question to you. The company has achieved a major breakthrough in its consultancy service in Middle East. What is Middle East? Middle East means what? The countries, Arabian countries like Dubai, Bahrain, Kuwait, okay, Saudi Arabia, all these countries together are called Middle East. Qatar, where lot of CAs are working. Okay, you can also try, you will get 5 times more salary and 1/5 taxation than what you pay in India, plus all the luxuries of life. Following which it has entered into a contract of rendering service with Finland Inc. for INR 6 billion during the year. So this is just an information that they have entered into a contract to render service to a company called Finland Inc. and the value of this contract is 6 billion rupees. Does it make any difference? No. This is just a contract entered into by a company. So this kind of information is not really required to be accounted for. At the most, if it is significant information, then it can be given in notes to account or it can be given in the director's report. The termination clause of the contract, but we are interested in this line. The termination clause of the contract is equivalent to INR 7 million. So, such big contracts have got penalty clauses also. And what is that penalty? 7 million rupees and is payable in case transition time schedule is missed from 15 December 22. In case if you miss this deadline of completion, then you have to pay 7 million rupees as penalty. But what is the line here? This is important and I am going to ask you a question. Ready? Be ready. Yes, Rahul, Anup, Hari. I am going to ask you a question. Management, however, is of the view that liability cannot be treated as onerous. So what will you do with this adjustment? Option A, provision 7 million. Option B, contingent liability. Option C, do nothing. Provision, contingent liability or do nothing. So for that, you have to recall, if you have studied one chapter in accounting standard, provision, contingent liability and contingent asset AS 29. In fact, the corresponding Ind AS 37 is also on similar lines only. Not majorly different, some difference, but basic idea in Ind AS is also same. So first of all, it is not a present provision because it is not a present obligation. It is just a possibility. Okay, so it's a possible obligation. But again, in possible obligation, do you think that there will be an outflow of resources embodying economic benefit? Management thinks that no, we are damn sure. that the contract can be executed on time. Management is of the view that liability cannot be treated as onerous, so we don't have to pay this liability. So it is just a clause in the contract. That does not mean you have to disclose it as a contingent liability also, unless you feel that there can be an outflow of resources embodying economic benefit. In AS29 you have studied, if the outflow of resources is remote, even disclosure as contingent liability is not required. Unnecessary disclosure will confuse the shareholder, unnecessary disclosure will attract uninvited criticism also. Some investor may move away from the company when the company believes that this is not onerous, this liability is not there, there is remote chance that it will have to be paid. So answer of the note 1 is do nothing, but at the most you can disclose in the director's report. Usually they disclose about this if they get some big contract. This is a big contract, 6 billion rupee is a big contract. Considering the total profit of the year, if you see below, is only 951 million. In front of that 6 billion rupee contract is a big contract, so they disclose it. Note number 2, again I am going to ask. So contingent was not the right answer for the first note. Company is not liable to assess the final liability for a particular tax assessment pertaining to assessment year 18-19, where it has received a demand notice of rupees 6 million. However, the company is contesting the same with CIT appeal as on the reporting date. So here there is a case against the company. Demand notice says pay 6 million. Company is contesting with CIT appeal. Option A, make provision. Option B, disclose it as contingent liability. Option C, do nothing. This time you will say contingent liability because it's a possible obligation and it will require outflow of economic resources if you lose the case. So there is some probability, maybe less than 50% probability, but there is some probability that you may have to pay this amount and you have to disclose it as a contingent liability. So this we will disclose, whereas the company has not disclosed in their financial statement. And then the P&L account is same, I am not reading, exactly same P&L account, exactly same note 1, note 2, note 3, note 4, note 5. Such a copy paste company, sorry, institute. And then what you are supposed to do, additional information, one same copy paste. Share capital comprise of 100 million, share of rupees 10 each. Term loan from bank includes interest accrued 555 million. Reserve for foreseeable loss is created against a service contract due within 6 months. Same thing required. Evaluate the report and report the errors and misstatement in the above extract and prepare the corrected balance sheet and statement of profit and loss. So first we'll write I have already written it for you. What are the errors in financial statement? All the 3 questions had one common mistake. What was that? They have not specified whether this Ind AS is applicable or not. They should have mentioned that. First note is same. Format should be as per division 2 of schedule 3. Second, DTA and DTL should be set off. Third, EPS should have been disclosed. Fourth, accrued interest should be shown in other financial liability under the head current liabilities. Fifth, reserve for foreseeable loss should be shown in the heading provision under current liabilities, not in the reserve and surplus. So regrouping is required. And this is one extra note I have written. company has entered into a contract for rendering services which has penalty clause of 7 million, which the company estimates as non-onerous. Means you don't have to incur any losses here. Non-onerous means you will not incur losses. Non-onerous means, onerous means cost of fulfilling the contract is more than benefit derived from the contract. So non-onerous means reverse, benefit is more than cost. Hence provision for expected penalty cannot be made since present obligation is not appearing on the balance sheet date and it is a possible contingent liability. Again, in contingent liability you have to see whether I need to disclose it or not. It won't be shown as contingent liability as the possibility of outflow is remote. Remote means there is very less chance that you will have to pay. So no disclosure required for note number 1 and disclosure will be required for note number 2. Company is contesting a demand notice of 6 million from tax authorities, but it is a possible obligation. Hence disclosure would be made like this under contingent liability note. Company has received a demand notice of how much? 6 million. Just make a correction because in the exam it was 12 million and in this MTP they made it 6. They reduce all figures by they reduce all figures by half. So somewhere I have also done the same thing. So 6 million which is contesting with CIT appeals. Okay. Remaining question is same. Let us solve it little fast. Will take 5 minutes only. You have the format with you, right? Today only one of this question. What you can do, you can try as homework. Okay, in the notebook without reading the answer. Check how much time do you take to complete it. So I will again start with balance sheet, question balance sheet. Question balance sheet starts with share capital. So we are going to write in SOCIE opening balance share capital 1000 and you write a note here. Share capital comprises of $100 million shares of rupees 10 each. No problem. Then come to second line of the question, reserve and surplus, where it is written note 1 2000. So I have to go to note 1 2000. What is that? Capital reserve 500. So they don't have creativity also. They can change the name of some reserve. Surplus from P&L account. Opening balance 49. Total in the outer column 1549. Is right? 1549. Okay. Now the next is long-term borrowing 5555. So I will have to first go to balance sheet. In balance sheet liability side, we have borrowing here, long term. How much I will write? 5555 minus interest accrued. How much is interest accrued in the adjustment number B? 555. So balance in the outer column. How much is balance in the outer column? 5000. And what will you do with this 555? Other financial liability. Note 5. Note 5. Is it there? Note 5? Any other financial liability? Note 5. I will come to that. There is one item pending, reserve for foreseeable loss. So write in note number 6, second line, provision for expected loss. Is it 500? 500. Okay, now we are on the right path. Deferred tax liability, note number 1. Which is more, deferred tax liability is more or asset is more? This time also asset is more. In the exam, be careful. They may give liability more. Then it will come as a deferred tax liability in the balance sheet. Don't remember the answer. Current liability, trade payable. Do we have any breakup of MSME and other thing? No. So directly go to, just a minute, there is some problem. One second. Okay, so I'll go to the balance sheet, liability side, trade payable. You can just remove these two lines in your answer. How much is that trade payable?
300.
Breakup is not given, so write directly. 300. Short term provision, do we have a note on that?
Yes. 6.
Note number 6. So provision given in balance sheet is how much? 250. Take the total. 750. 750 write in balance sheet. Current liabilities, provisions here. Note number 6. How much you said? 750. Back to your question. Other current liabilities. There is a note number 4 in the question. What is note number 4? Unclaimed dividend. Where will I put that unclaimed dividend? Other financial liability. Amount? 3. And billing in advance. Other current liabilities. Do we have a note on that? No. So directly in the balance sheet, there is only one item, so I am writing here. Other current liability, last item, billing in advance, 147. So can you take the total of that other financial liability? 558. Is right 558? So I will go to balance sheet, other financial liability 558, current liability. Next line in the question is fixed asset 5655. Asset side first item PPE 5655. You will not write fixed asset, you will write PPE. Deferred tax asset, we have a note number 1. 500 minus 200. So is it 300? Back to balance sheet, asset side, second line. Deferred tax asset, how much you said? 300. Okay. Next item in the question is current asset inventory. No adjustment in inventory. Directly write in the balance sheet 1000. Trade receivable, we have a note for that. Same thing. Note number 2 in our answer. Just write down the same thing. Secured. How much is secured good?
1065.
1065. In bracket write less than 6 months. Nowadays lot of bad debts are happening, and that is why the disclosure requirement has gone up for debtors, receivable, loans. And then consider doubtful means debtor significant credit risk. You can say more than 1 year. Wherever the aging is given, please write 40. Less allowance for bad debt 5. So the total is 1100. So student will come to asset side, trade receivable 1100. back to balance sheet of the question, cash and bank balance. Do we have any note on that? No. So you just remove this line. Cash and bank balance is 1200. And do we have any note here? Remove this note if it is there in your book, because there is no adjustment given for cash and bank balance, right? So I don't know how that has come. And other bank balance also remove here. Next line, note number 1 in the question we have read, that does not require any disclosure. Note number 2 requires disclosure of contingent liability. So just check, is it already printed in the book? Demand notice from Income Tax Department pertaining to INR 6 million under contrast with CIT appeal on the reporting date. You need not remember this line, you can write in your own way. Then I'll come to P&L account. This does not have much adjustment. So start with revenue from operation 5500, then employee benefit expense 1200, then operating cost 2200, depreciation 999, total 4399. PBT is how much? Tax expense 150, PAT, basic EPS 951 by 100, 9.51 in rupees. Other comprehensive income is not there. So this total comprehensive income will be 951. This time there is no adjustment. Then I'll just check whether we have read all the notes in the question. Note number 1 in the question, reserve and surplus done, long term borrowing done, deferred tax done, other current liabilities done, trade receivable done, additional information A, B, C, D, E. No, E is not there, D is not there, we have done. So now your time to close your SOCIE first. How much was current year profit? 951. Is there any dividend in this problem? No. So tell me the total. This 1000, 2500. So what I'll do now, I'll go to balance sheet, liability side, share capital, how much?
1000.
And other equity 500 plus 1000, 1500. Next thing you have to check whether all notes you have transferred, deferred tax, trade receivable, then other financial liability provision we have transferred.
Yes.
Now you can take the total of the asset side first. 9255. Okay, take the total of liability side also.
9255.
Tallied. So based on whatever information was given, we have done. So now there is a question number 9, but we'll take a small 5 minutes break. This is important, this is different also. So take a 5 minutes break. We will come back after 5 minutes. Okay, we are back. So now we'll take one very important question. Okay, question number 9. See the length of this question. Almost 2 full-scale pages, and it was given in first RTP November 2020, then MTP November 2021. So the next destination is next destination is exam only. Schedule 3 is a part of your syllabus and they have asked question on this. So question number 9 will require knowledge of some other standards also. So today you have to trust me for certain adjustment, okay? Like in this question we are going to calculate deferred tax also. We are also going to present OCI also. So some adjustments are also there. Deepak started a new company, Soft Bharti Private Limited, with Iktara Limited. So this is two companies, Deepak and Iktara, they combined together and they formed a company called Soft Bharti, wherein investment of 55% is done by Iktara. So who is the holding company here? Iktara is holding company, Soft Bharti is a subsidiary company, and Deepak is a non-controlling interest. Okay. Voting powers are to be given as per the proportionate share of capital contribution. So Iktara will have 55% shareholding, Deepak will have 45% shareholding. The new company formed was the subsidiary of Iktara Limited with 2 directors, and Deepak eventually becomes one of the directors of the company. Is this line relevant? Deepak becomes one of the directors? Useless line, unnecessary waste of time. A consultant was hired and he charged rupees 30,000 for the incorporation of the company. So this is called preliminary expense, company formation expense, and do other necessary statutory registration. Rupees 30,000 is to be charged as an expense in the books after incorporation of the company. So for accounting purpose, preliminary expenses will be fully written off in the same year. Is the adjustment right? All of you know that. Your accounting standard 26 also says the same thing, and we will see Ind AS 38 also says the same thing. So they have proposed correct adjustment. Preliminary expenses should be transferred to P&L account. They have done it. So as far as accounting wise there is no problem, but it can have a tax implication, because under income tax law, preliminary adjustment can be claimed as deduction in 5 installment. Do you remember that? So it will give rise to deferred tax adjustment. The company Soft Bharti, means the subsidiary company, was incorporated on 1st April 2019. The financials of Iktara are prepared as per Ind AS. Now, if parent company follows Ind AS, subsidiary will also have to follow Ind AS. Soft Bharti is a subsidiary. So subsidiary will also follow Ind AS because its parent company follows Ind AS. An accountant who was hired at the time of company's incorporation has prepared the draft financial of Soft Bharti Private Limited for the year ended 31st March 2020 as follows. So this is the statement of profit and loss. Revenue from operation, other revenue, other income, total revenue. It should be total income. Just correct it. Total income. Expenses. So this is a good question for exam purpose. Purchase of stock in trade. Increase or decrease in stock is given here. So if there is any adjustment in the stock, you can adjust this item. Employee benefit expense, depreciation, other expense, total expense, PBT, current tax. Deferred tax is already calculated by them. These two taxes they have calculated, and if tax rate and adjustments are clearly given, we will have to check if it is correctly done. Total tax expense and profit for the year. So this is their calculation. We have to do our calculation because there are lot of adjustments. Now they have given a long balance sheet also. This balance sheet, this accountant has prepared as per division 1 because he thought that we are not complying with Ind AS, but he forgot that the parent company is complying with Ind AS, so subsidiary will also have to comply with Ind AS. So we'll have to change the format of this balance sheet. Share capital, reserve and surplus, current non-current liabilities, long-term provision, deferred tax liability. The same 6,000 which you have seen in the P&L account, they have shown in the balance sheet also. Current liabilities, trade payable, other current liabilities, short-term provision. Non-current asset, PPE, long-term loans and advances, other non-current asset. Then current asset. Current investment is also there. Inventory, trade receivable, cash and bank, other current assets. Balance sheet is not very difficult, but there is a long list of only 9 adjustments. Okay. Additional information of Soft Bharti Private Limited. Deferred tax liability of 6,000 is created due to falling temporary difference. Now what is the meaning of deferred tax liability? It means the liability which will arise in future because of any tax benefit you enjoyed today. Is it right? Like for example, in income tax, you can charge more depreciation compared to books. So you will be happy that I saved tax in this year, but you will pay more tax in future year because your block of asset will reduce. So that give rise to deferred tax liability. So if you save tax now, but you will have to pay more tax in future, that situation will give rise to deferred tax liability. And if you pay more tax now and save tax in future, that situation will give rise to deferred tax asset. Difference between accounting presentation and tax presentation arise because of difference in the treatment under the rules of accounting and under the tax rules. Like in books of account, depreciation can be straight line WDV. You can choose the rate according to useful life, but for income tax purpose, in most cases the method is WDV. The rate is given in the law, plus you follow block of asset method. In accounts we follow depreciation of individual assets. Is it right? That was just one example. In books we debit provision for expenses, which reduces my profit, but for income tax purpose you can't make provision for expenses and reduce your taxable income. These are few examples. There are many more. So in this question, they have explained you why this difference of 6,000 has come. Difference in depreciation amount as per income tax and accounting profit. There is only one PPE in the company whose closing balance on 31st March is as follows. As per books 1 lakh and as per tax law 80,000. So what is the difference? This difference is called temporary difference because the difference will reverse. Difference will reverse. So temporary difference of 20,000. And because you see carefully, if the block of asset is lower under income tax law, it means you have claimed more depreciation. So more depreciation claimed now means less depreciation will be claimed in future. In future you will get deduction of only 80,000 rupees. Yes or no? So it will give rise to deferred tax liability, which will be 20,000 into tax rate. Search for tax rate in the question somewhere below, 30%. So which means 6, and the same 6,000 they have taken in P&L account and second effect in balance sheet. So as far as this part is concerned, they have already done the correct treatment. We are not required to do anything. Then third point, pre-incorporation expenses are deductible on straight line basis over a period of 5 years as per income tax. However, the same are immediately expensed off in the books. So in the books you have written off how much? 30,000. But for tax purpose you will be allowed only 6,000. So difference will be 24,000 into 30%. So 7,200 will be what? DTA or DTL? Deferred tax asset, because you will save in tax in future. Right now it is disallowed, so you will cry. But next year, without doing anything, you will claim 1/5 of 30,000, so you will save tax. So if adjustment is such that it results into more tax saving in future, this will give rise to a DT of 7200. But have they provided for this DTA in their books? No, because only 6,000 is provided, which means other deferred tax adjustment they have not done. So we will do it. We will do it. Okay, 7,200 DTA we have to provide for this item. Understood? In case if you are finding little difficulty, don't worry. Come back to this question after Ind AS 12 is over, and then you will find that these adjustments are upper KG class adjustment. Okay, because you have done Ind AS 12. Don't worry. But at least you have studied deferred tax in intermediate AS 22. So logic is same, but the way the calculation is done is different in Ind AS 12. But the basic idea is same. Then current tax is calculated at the rate 30% on PBT, that is 3,55,000. So if you look at your question, how much tax they have calculated? 3,55,000 into 30% is how much? 106,500, and that is what is appearing in the balance in the P&L account also, balance sheet also, short term provision. But there is a problem. This calculation is wrong. Why? Without doing any adjustment relating to income tax, the correct current tax after doing necessary adjustment of allowance, disallowance relating to income tax comes to 125,700. So say thank you. Otherwise we will have to prepare one statement of computation of tax liability also. Is it right? So now you don't apply your mind. When the institute says the correct tax liability is 125,700, take it and say thank you. Otherwise you will have to prepare one current tax statement also, because your depreciation is different in the accounts book and for tax purpose. Preliminary expense treatment is different in books of account and for tax purpose. So all this will affect your current tax calculation. Because this is not a tax subject, they were kind enough to give you current tax figure. After the reporting period, directors have, after the reporting period, underline after, the directors have recommended, means proposed. Recommended is not declared. After there is over, the directors recommends to the shareholder that in our view, this is the dividend that we should pay. So this is useless. It will only be disclosed. But what they have done, oh my God, recommended dividend of 15,000 for year ended 31st March 20, which has been deducted from reserve and surplus. So I will show you your question. Come to your question book, balance sheet, reserve and surplus. You will find 227,500 is there. P&L account, if you see 242,500 is there, PAT in your question book. And if you see the difference, it is exactly 15,000. And that is because they have provided for proposed dividend. Should we provide for proposed dividend? No. So we'll have to reverse this entry. We have to reverse the entry. Original entry they have passed is P&L account to proposed dividend. Reversal will be proposed dividend to P&L account. And where is this proposed dividend appearing in the problem? Dividend payable of 15,000 has been grouped under other current liabilities along with other financial liability. So if you go to other current liability in the balance sheet 45,000, which includes 15,000 rupees dividend payable also, remove that. So 45 will become 30. 45 will become 30. Tick mark that item. Tick mark that item. Tick mark reserve and surplus also. You need to remove that 15,000 from there. Then it's written there are some government statutory dues amounting to 15,000 which are grouped under other current liability. Government dues, is it a financial liability or non-financial liability? Non-financial liability. So it is correctly shown in other current liability. Everything is not wrong. This is correct. Don't do anything. Maybe you can show it separately under other current liability if you want, but not really required. Government dues can be presented under same heading. Then the next item is the capital advance amounting to 50,000 are grouped under other non-current asset. Correct. You can put it under other current asset, other non-current asset. Capital advance means advance given to purchase capital goods. It's not a financial asset because the contract is not to receive cash. The contract is to receive capital good like machine. Next is other current asset of 51,000 comprise interest receivable from trade receivable. This will be other financial asset. So it will be regrouped. It will be removed from other current asset and it will be presented in other financial asset. Is it right? Only that regrouping will be there. Now next is current investment of 30,000 is in shares of a company which has been done for the purpose of trading. So it will come under current asset. Okay, it will come under current asset. Do we have in current asset investment? Yes. So this is that they are talking about current investment. So next is there is an adjustment. Current investment has been carried at cost in the financial statement. The fair value is 50,000 on 31st March 2020. Now if you are a student of accounting standard, then it is right. Cost or fair value, whichever is lower. But if you are a student of Ind AS and if it is held for trading purpose, means its classification will be FVTPL. Financial asset held for trading purpose means your objective is to trade, make profit, buy and sell, and such instrument are classified as fair value through P&L account. So we'll have to do fair valuation of that. So we are going to show in balance sheet 50,000 and the 20,000 will come under P&L account other income. But there is a small problem here. In books of account, you have increased it to 50,000, but income tax law will still consider it as a 30,000. So there is a difference, 20,000. This will give rise to deferred tax asset or liability.
Deferred tax liability.
It will give rise to deferred tax liability because today you are increasing your value of the asset by 20,000, but you are not paying tax. Next year, suppose you sell it for 50,000, then 50 minus 30, 20,000 will become your taxable profit in the next year and you have to pay tax. Today you enjoy, but next year when you sell for 50, you will pay tax. So this will give rise to deferred tax liability of 6,000, which they have not adjusted. So we will have to adjust it. Next is actuarial gain on employee benefit measurement of 1,000 has been omitted in the financial statement. Error of omission. Actuarial gain on employee benefit. This is you are going to study in Ind AS 19. Post-employment benefit plan or defined benefit plan requires you to get your liabilities and asset valued by the actuary, and that may result into gain or loss. This is shown in OCI. It is an OCI item, non-recyclable item. So this has completely been omitted. So 1,000 rupees I will show as gain, means profit in OCI, and the second effect will be, go to your question book balance sheet liability side, you will find their long-term provision 25,000 is there. Is it right? So that will reduce by 1,000 because there is a gain, means liability will reduce. So 25,000 will become 24,000 now. Is it right? So 25,000 will reduce it by 1,000. In the balance sheet, 1,000 will get reduced. It will become 24,000. In OCI will show 1,000. In SOCIE that 1,000 will be transferred. But it will have a tax effect also. So we'll have to create a deferred tax. Asset or liability? You're having gain but you're not paying tax. So liability of 300 rupees. It's a gain but you're not paying tax. So it will give rise to liability in future. Whenever that benefit will be settled, you'll have to pay tax on that. So 300 rupees deferred tax implication. Then financial statement for year 1920 have not yet been approved, which means you first make all the adjustment, then give it to the board for approval. You means not me. You are required to ascertain whether the financial statement of Soft Bharti are correctly presented as per applicable financial reporting framework. So financial reporting framework applicable is Ind AS to this company, but they have followed accounting standard and division 1. If not, prepare the revised financial statement after the careful analysis of mentioned facts and information. First it was asked in November 2020 and then November 2021. So November is a favorite month for this question. Understood? So just check whether format is given to you. Now just to read the question we have taken 22 minutes. And if you are solving yourself, to draw this format will take another 40 minutes or 20 minutes at least, and then solving will take another 40 minutes. So in the exam such questions should not be attacked first. This should be kept for the last. First you have to solve all small questions which requires 5 minutes, 8 minutes, 10 minutes. In the exam situation this question will require at least 70 to 80 minutes at least, or if you've already done in the class and then it is asked 60 minutes, because drawing etc., format etc. will take time and you have to read the question in the exam because something they can change also. So what I'll do, you have drawn P&L account, you have drawn SOCIE, we have balance sheet also. Note 1 other income, note 2 other current liability, calculation of deferred tax. One working I want you to finish first, because once that is done then I can move smoothly. So there is a working note 1 calculation of deferred tax at the end of the answer. Okay, you will find at the end of the answer. So calculation of deferred tax. On how many items we have deferred tax adjustment? 4 items. PPE, preliminary expense, actuarial gain, and one more which is not printed by mistake, the current investment also. So 4 items will have deferred tax implication. So in your book I have drawn the format, only one line item you have to introduce somewhere in the answer. So first PPE, book value, write down 1 lakh, working note 1 at the end of the answer in your book. Tax, book value 80, temporary difference. This is called taxable temporary difference because it will be taxed in future. The difference will be taxed in future. So tax rate is 30% and deferred tax liability will be 6,000. This they have already done, no problem. Preliminary expense, book value is 0 because 100% write-off. Tax book will be 30,000 minus, right calculation, 30,000 minus 30,000 by 5. Today you will understand 24,000 if you write directly. After 6 months or 3 months when you will open the notebook, then you will wonder how 24 has come. So this will be called deductible temporary difference because you will save tax in future, 24,000. So therefore deferred tax asset at the rate 30%, 7200. Then you can insert one line there, current investment. Current investment, one line above actuarial gain, insert current investment, and you can continue in the same line DTL. It will give rise to DTL. How much? 30,000 is book value. Later on increase to 50,000. So 20,000 you are increasing the profit in the books but not paying tax. You will pay tax in future when the investment will be sold. So 6,000 DTL. These 3 items, PPE, preliminary expense and current investment, the net effect of these 3 items will come in statement of P&L account. So how much is that net total? 6 plus 6, actual gain will come, but that will be shown in OCI. So I will write below. Anybody for the total, net total, 6 plus 6 minus 7,200. So write their net DTL to be shown in P&L account. One student is asking why not actuarial gain. Actuarial gain we will calculate, don't worry, but that will be shown in OCI. So mistake we make is we add that also and write in P&L account, but that is an OCI tax, OCI deferred tax. Okay, write below, which is printed in your book. Yes, I can show anything relating to syllabus, not my portfolio. Okay. So just check whether you have noted down everything, because once you do this, then I don't have much problem. I can do it fast. Below this you write one more item. Have you written this line?
Yes, sir.
To be shown in P&L account, because your query was why we are not adding actuarial gain or loss. So that we will show in OCI. Write down below actuarial gain, tax will be charged in future. It's written change, make it charged, because if you gain now and you don't pay tax, you pay tax in future. Tax rate 30%, or write directly 30% of 1,300 deferred tax. But where will this be shown? Will be shown in OCI. Spelling mistake. Will be shown in OCI. So this 300 will come in OCI, and in balance sheet how much deferred tax liability will come? 4,800 plus 300 in balance sheet, because in balance sheet I don't have to separately write DTL relating to P&L and DTL relating to OCI. So for balance sheet purpose, total DTL 5100. So this you write down, it will go to balance sheet. 4800 P&L account, 300 OCI, and total 5100 will appear as deferred tax liability in the balance sheet. Okay. So now I am ready to solve this question. I have to go behind. So start with your first line of the question. Revenue from operation. Please all of you come to statement of profit and loss. Revenue from operation. Is there any adjustment in that? No. So can I write directly 10 lakh here? Other income, note number 2, there is an adjustment, because we have to also add that fair value gain on current investment. So where is my note number 2? Note 1, okay, note 1, second line, other, how much is that? 1 lakh? Other income 1 lakh given. Then I will come to expenses. Purchase of stock in trade. Do we have any adjustment in that purchase? No. P&L account, point number D1, 5 lakh. Then change in stock, do we have any adjustment in that? No. 50,000. Employee benefit expense, no adjustment, 1 lakh. 75,000. That actuarial gain income will come here. Actuarial gain will come here. Not now. We'll come back to that. Don't break the order. Depreciation, no adjustment. 30,000. Other expense. Do we have adjustment in other expense? No adjustment. 90,000. Okay, this total you can take because this is logged. How much is the total of 7,45,000? No problem. And next item is profit before tax. I will not write. Current tax will be revised figure, which is given in one paragraph. Current tax was how much? Read adjustment number 4, 125,700. 125,700. And we are going to also write in balance sheet, liability side here, current liability, provision for taxation. This figure you will write 1 lakh 25,700. 125,700. Okay. Then deferred tax, how much we had calculated for P&L account?
4,800.
For P&L account deferred tax we have calculated 4,800. Right, refer working note 1. And deferred tax here, tax liability on above 300 we have calculated. Refer working note 1. This you put in bracket because there is a actuarial gain. Okay. So 4800, 300. So total deferred tax liability will be how much? 5,100. Where I will put it? Balance sheet, liability side. In balance sheet liability side, non-current liability, you have provision. Oh, you don't have space there. Adjust. India teaches us adjustment. Okay. So insert DTL, working note 1, 5100, 5100, working note 1. Then next, in your question book, you have total tax expense. So total tax expense in P&L account will be the sum of these two numbers. Anybody for total tax expense? 1,30,000, 130,500. PAT I will write later. EPS I will write later. Other comprehensive income, item not to be recycled, remeasurement of net defined benefit plan, actuarial gain 1,000. So OCI for the period 700, and this 700 I can write in SOCIE third column under total comprehensive income. 700, sorry. Okay, just write there because retained earning is pending. So this completes my P&L account from the question book. Very important question. It will come for at least 14 to 16 marks, and you can get full marks if you are well prepared. Share capital SOCI, which line? Opening or issued? Opening is 0 because this is a new company. This is a new company, first year of its operation. So we will write in issued capital. How much will write? Have they given you face value somewhere in the question? Is the face value given? No. What will you do? Assume 10 rupees. Assume 10 rupees. So you write down share capital comprise of 10,000 shares of rupees 10 each. Face value equal to rupees 10 assumed. No problem. You can assume 100 rupees if you want. And next line in the question is reserve and surplus. Reserve and surplus I will have to recalculate. Okay, so don't worry, because it will be based on this PAT figure and OCI figure. OCI I have written, PAT is pending. And next line is non-current liability, long-term provision. Come to balance sheet, long-term provision. You will see in the non-current liability we have written provision, in bracket defined benefit obligation. How much is that? 25,000 is there, but it will reduce by 1,000 due to gain. So liability will reduce, it will become 24,000. Deferred tax liability we have already adjusted. Current liability, trade payable. Do we have any adjustment in trade payable? Trade payable, so write down here trade payable 11,000. Please practice on your own also. Then next is other current liabilities 45, but there is a adjustment. Do we have a note on that? Yes. So other current liability, you write here note number 2. This is your note number 2 in the book. Is it there? Yes or no? Yes. So there you have other current liabilities as per financial statement 45,000, and remove the proposed dividend 15,000. So how much is the balance? 30,000. Now reclassification of government statutory dues, that you delete. That is wrong. It should be included. You can just mention here includes government statutory dues, because that will come in other current liability only. Some authors, what they do, they further divide this 30,000 into two separate line item. Government dues 15,000, other current liability 15,000. That is okay. Then the student had asked me a query on email, why we have not given the second effect of this 15,000. Interesting query. Because I am not going to take the reserve and surplus of the question book, which is arrived at after deducting 15,000. I am doing a fresh calculation of profit, which is before deducting dividend. So since I am going to take the profit figure from P&L account, which is before deducting dividend, there is no need to again adjust dividend. So you come to other current liability 30,000. If you want, you can divide this 30 into two line. Government dues 15,000, other current liability 15,000. But that is okay. Now we'll come to next line item, short term provision, which will have provision for tax. I think we have already replaced. It's a replacement. Even in P&L account we have changed, in balance sheet also we have changed. So the effect will match. Understood? The effect will match, because same amount we have also replaced in a P&L account. So no further effect. Now there is an asset side, plant, property, plant and equipment. Do we have any adjustment in that? No. So write down 1 lakh. Next is long term loans and advances. So financial asset, loans and advances 40,000. Then other non-current asset 50,000. Other non-current asset, only one line I have added here, capital advance, separate presentation, capital advance 50,000. Then current investment will be how much now? Financial asset investment will be 50,000, but your trial balance or balance sheet given to you is 30. So where is the 20,000 effect? It will be added in other income. It will be added in other income, note 1. Fair value change on investment at FVTPL 50,000 minus 30,000, 20,000. So my total will be 1,20,000. So I'll go to the balance sheet, sorry, P&L account. P&L account, second line, other income 1,20,000 here first, and total revenue, you just make it total income 11,20,000. This small change was made in the amendment, that don't write total revenue, write total income.
Can you please explain this classification again from other non-current?
Which one?
This, what we did right now.
Financial asset.
This entire.
So that is what we have done. We have passed one small entry.
Current investment.
Investment account debit 20,000 to fair value gain 20,000. So investment which was in my books at 30,000, we have appreciated it by 20,000, and this fair value gain will be shown in P&L account as other income. So that is in note 1, other income 20,000. Is it there, 20,000? So we have given the effect of this entry, which they have not done. We have done. They have recorded 30,000. but we have to record 50,000. So 20,000 extra I have to record. So that will affect my investment value and affect my profit figure also. And the deferred tax implication we have also adjusted in deferred tax calculation. So we have done current investment. Inventory, do we have adjustment in inventory? No adjustment. So current asset inventory, right, 80,000. Trade receivable 55,000. No adjustment. Trade receivable 55,000 under financial asset. Then cash and bank, no adjustment, 1,15,000. Other current asset 51, that I think we have regrouped here under other non-current asset, 51,000. Is it right? Capital advance, wait.
Other financial assets.
Other non-current asset 50,000 was?
We put it in other financial assets. It is interest receivable.
Okay, just wait, I'll check. So this last item, other current asset 51,000, where was the adjustment?
Number 8.
Number 8. Other current asset of 51,000 comprise interest receivable. Okay, yeah, this is that item. So this will be other financial asset. I have changed the nomenclature here. Interest receivable 51,000. Yes. Now we have completed the given balance sheet, and almost all adjustment we have done, almost all. So I'll quickly ask you, and you have to say whether it is done or not. Additional information: 1. Deferred tax liability of 6,000 done. 2. PPE done. 3. Pre-incorporation done. 4th, current tax done. 5th, dividend proposed, adjusted, 15,000 we have removed. Yes. Government dues we have shown, not separately but in other current liabilities, which is okay. Capital advance 15,000, so that is also okay. Other current asset, other non-current asset. Other current asset 51,000 comprise interest receivable. That also we have just changed the name to other financial asset. Then current investment was increased from 30 to 50. We have done. The entry is right now also appearing on the screen. And the deferred tax we have done. Actuarial gain also we have adjusted. Deferred tax on that also we have adjusted. In OCI and SOCI also we have adjusted. So this is almost done. So what I should do, first I will check whether all notes are complete. 120 we have transferred to P&L account. 30 we have transferred to balance sheet. So we'll go to PAT. First we'll find PAT. Before that PBT. 11,20,000 minus 7,45,000. 3,75,000. Then minus 1,30,500. 244. EPS will be 244,500 divided by 10,000. 24.45. Other comprehensive income 700 we have computed. 244,500 plus 700. 245. 200. No. 245? 200. Okay, 245, 200 is your total comprehensive income. This 700 I have already written. 244,500. This you write in SOCI here. 244,500. So now we'll complete the rows first. complete the rows first. So total in the last column 245, 200, and then vertical total 1 lakh, 244, 500, 700, 345, 200. Share capital will go to share capital. The total of these two will go to other equity. So come to balance sheet liability side. Share capital is 1 lakh, 245, 200. Tell me asset side total now. Asset side total 5,41,000 is right. 5,41,000. This is a very important question asked in November 2020 RTP, November 2021 MTP. One of the lengthiest questions ever asked in the exam or in the RTP. There are few more such questions. And is the liability side telling? 5 lakh, power of double entry bookkeeping system. If you give the double effect properly, it will tally. Okay. So this completes this question number 9. Your schedule 3 division 2, also division 1 have been slightly amended, which is a part of schedule 3 only now. So we are going to discuss some major adjustments, amendments that have happened in schedule 3. Some disclosures are also written in your answer. Disclosure forming part of the financial statement. First is proposed dividend of 15,000 is subject to the shareholders of the company at the AGM, subject to, write down, approval of, subject to approval of shareholders of the company at the AGM and not recognized as liability as at the balance sheet date. Second note is presentation of financial statement by Soft Bharti is not correct. This should not be in the format given by division 1. It should be as per division 2. Why? Because it's a subsidiary of Iktara. Parent is applying Ind AS. Subsidiary will also apply Ind AS. So this question was well drafted. Now we'll come to the schedule 3 continues. Okay, because from 1/4/2022 companies have to also give these disclosures. These amendments are basically more for disclosures. Okay, in the notes more disclosures are required so that the investor can understand the performance of the company, can understand the risk of the company, can understand the liquidity of the company, can also understand management's integrity, can also check how the management is managing the funds, and some of the amendments were made so that it will be in line with the CARO, so that when the auditor is auditing that CARO requirement, he will find that most of those are also incorporated in the financial statement. And because now it is a part of the law, companies have to observe these disclosures, even though unwillingly, because as we will see, there are a lot of disclosure requirement which will not be comfortable for the company. But you are a company which takes funds from the public. You have a duty towards the public, towards the shareholder. You should give them enough information so that he can take a more informed decision. That is what is the purpose of financial statement. So you will find that so many new disclosures they have added, which they should have done 50 years ago only. Is it right? To my understanding. But why they took so much time? And still lot of improvements are required in this, trust me. So this Schedule 3 was amended via a notification on March 24, 2021. The purpose is to add some more disclosures in the financial statement which is prepared by the entity. So you will find it's more about disclosures part. In the notes to account, the disclosures will be given. So one is shareholding of promoters also. How many shares are held by promoters in percentage term also, and whether there is any change during the year. If you find promoters are selling the shares, earlier you are probably not aware, unless it's a listed company where they have to give disclosure, but for unlisted company, the other shareholders will not get to know. Okay, so now that is mandatory. So the note on share capital in the financial statement shall mention detail of the shareholding of the promoters along with changes, if any, during the financial year in the following format. Okay. Now you have to give the name of the promoters who are holding shares. Then what is the percentage of share they are holding? And the important thing, is there any change during the year? If they are buying the share, they are comfortable with their company, they are confident. But if they are selling in bulk, which means they are understanding that something can go wrong with my company, so why not to take the money and move out? So you will find usually in the stock market, if promoters are selling the stock, share price goes down, because then the investor think that promoter themselves don't have the confidence in the company. Otherwise, why they will sell? Detail will be given separately for each class of share. If you have more than one class of share, as you know, equity share of two types, with voting right and differential voting right. Preference shares are also of different types. So disclosure will be given for each type. The percentage change will be computed with respect to number of share at the beginning of the year. And if the shares are issued during there for the first time, then with respect to the date of issue. If you observe share market, when the company issues IPO, there is a lock-in period for the promoter. And once the lock-in period is over, usually after 1 year or 6 months,
90 days.
or 90 days, I don't know, maybe a 90 days, I am not sure. So whatever is that lock-in period, and they start selling the share, the price crashes, like it happened in the, I think, Zomato, Paytm, Nykaa, all this so-called new age company. Okay, then earlier there were not major disclosures about trade payables, because focus was more on trade receivable. But trade payable disclosure also they have increased now. There was no aging schedule of trade payable, but now they have also increased the disclosure where you have to also give aging schedule of the trade creditor. Also there was no disclosure requirement relating to disputed dues. Now that also will be given. Now this will put a lot of pressure on the management now actually. Is it right? Why? If there are a lot of disputed item on the balance sheet, new parties will not deal with you. Getting credit from one different set of supplier will become difficult, because if you are a company, your balance sheet is accessible. For listed company it is in the public domain, but for unlisted also they can ask for the balance sheet, or they can get it from, I think, ROC or something, somehow manageable. And then if you find that lot of disputes are with the creditor, getting further funds will become difficult. Getting credit in the market will become difficult, and that is also required because many companies, they take credit from suppliers, small supplier, medium supplier, and then they block their funds, and because of that the small and medium enterprises, they become bankrupt, or they have severe liquidity problem. They borrow at 24-38% interest rate because they have to survive. So that disclosure is required. So what is the disclosure for trade payable now? First is, you see, aging, age wise also, less than 1 year, 1 to 2 year, 2 to 3 year, more than 3 year. And not only that, you have to divide between MSME and others. Within that also you have to say disputed one with MSME and disputed ones with others also. Lot of pressure on management to take care that nothing comes under this disputed categories, okay, and nothing comes under more than 2 year, more than 3 year, which means they are delaying the payment. There is a liquidity issue, okay, there is a problem of working capital management with this company. So potential investor, bankers will not give you loan. Now banks are also very careful. Then same thing they have done for trade receivable also. Earlier it was only 2 criteria, more than 6 months, less than 6 months, but they have increased it, okay. And the disputed dues was also not disclosed earlier. So they have asked you to also give a disclosure of disputed dues. So see the aging schedule here, less than 6 months, 6 months to 1 year, 1 to 2 year, 2 to 3 year, more than 3 year. If you find you have lot of items in 2 to 3 year, more than 3 year, it means your debtors are actually not paying. Something is wrong with those debtor, or they may be fictitious debtor also, just created in the books by dummy entries, or they may be group companies where you have siphoning of the funds. So then the auditor or the government, tax officers, shareholder, bankers, they will ask you why they are outstanding for so long. Then you have to divide in following formats also. Undisputed trade receivable considered good, undisputed trade receivable considered doubtful, disputed trade receivable considered good. There is a dispute, you will pay, but you are not agreeing on some numbers, and disputed trade receivable considered doubtful, which means the shareholders, the outsiders will have a look at it, and then they will take their decision whether to invest in such companies or not. Especially when you are borrowing for a short period of time, the bankers will have a close look at this number. Or if you are having a trade creditor, he will also look at this number and he may take his decision not to give you the credit. In addition to that, the company will have to give following bifurcation of debtor: debtors considered good, debtor considered doubtful, debtor considered credit impaired, then trade receivable balance where there is a significant increase in credit risk, which we have discussed in some question today, and then undisputed and disputed. So a lot of emphasis on debtor, because companies carry huge amount in balance sheet in the form of debtors, and earlier this breakup was not available. Based on that, they were taking working capital loan, cash credit, bank OD. Now the bank will also get to know the breakup of the debtor, and accordingly their lending policies can get changed also. Very important, because a lot of frauds, scams, delays happen and public money gets blocked. Then with respect to property, plant, equipment, and the same disclosure for intangible asset also. So I have clubbed both of them. In case if you have revalued, and if the revaluation is more than 10%, an additional line item is required to be added, that is the amount of change due to revaluation, if the change is more than 10% or more in the aggregate of the net carrying value of each class of property, plant and equipment. So before you do revaluation, keep this in mind, this disclosure will be given by you. Then title deeds of immovable property not held in the name of company. Oh my God. Simply if you have bought some immovable property in the name of other parties like promoters, directors, employees, you have to give disclosure about this. So then the other parties will also get to know which all immovable properties you have held. Okay, so details of all immovable property other than property where the company is the lessee and the lease agreements are duly executed in favor of lessee, whose title deeds are not held in the name of company. Title deeds are not in the name of company for some reason. It can be in the name of promoter, director, employee, or where such immovable property is jointly held with others. Then details. What are the details? Relevant item in the balance sheet. Then description of that property, for example land and building, gross carrying value, title deeds held in the name of, in whose name, so name of that party, and whether that party is a promoter, director, relative of promoter, director, employee of promoter, director, property held since which date, and reason for not holding in the name of the company. There can be a genuine reason also, and also indicate if there is any dispute. Relative and promoters are defined in Companies Act. Next point is, at some place there was a typing error also. Fair value of investment property. Fair value of investment property. So company shall provide details of immovable property. I think this line got repeated. Other than the property where the company is, this is copied from the previous line. Okay. Fair value of investment property. Will come to the original text given at the end. Okay, later on you can please check. This requirement is added to align with the requirement of Caro. Where is the original text? You will find it there. Okay. Okay. You will find in that original text at the end. Later on you can see that is probably in page 2.59. Just come to page 2.59. From the top there is a second Roman point. The company shall disclose as to whether the fair value of investment property, this you have to put it here, as measured by disclosure purpose in the financial statement, is based on a valuation by a registered valuer as defined under Rule 2 of the company's registered valuer and valuation rule. That will come here. Okay. This you can just cancel because it got repeated from previous paragraph. Please rectify. We are also human beings. Next point, revaluation of PP and intangible asset. Companies that have revalued its PP, including right of use asset or intangible asset. Same disclosure for PP also, which is for investment property. Whether revaluation is done by a registered valuer, and if yes, you have to disclose it. The registered valuer is defined in company's registered valuer and valuation rule. Otherwise, companies, what they can do, they can increase the value of their PP item, investment property item, but then it has to be done by a registered valuer, and the registered valuer will have to give a certificate. So if he gives a false certificate, then he will come into trouble. Now what is capital work in progress? Capital work in progress means those projects which they have started but not yet completed. Earlier there was very minimum requirement for capital work in progress, but then in schedule 3 what they have done now, they have made some elaborate requirement for capital WIP. Why? Because lot of funds are blocked. Companies start the project and there is delay. And what do you see in the balance sheet? One line item, capital WIP 5 crore. But whether that 5 crore is blocked since last 1 year, 2 year, 3 year, more than 3 year, you never knew that. So now the company will have to give aging analysis of capital WIP, and you have to give projects which are in progress and projects which have temporarily got suspended. Oh my God. Is it right? Management, I will retire from the management if I have to do all this. Then you have to also give disclosure project wise also. You have to also give disclosure project wise. Which project was started 1 year, 1 to 2 year, 3 year, 4 year, like that. Details of the project where activity has been suspended shall be given separately. As I have told you, lot of companies have lot of funds blocked in this ongoing projects, which they simply disclose as capital WIP. Now that breakup is available. That will give a chance to the investor to ask this question, why that money is blocked. Same thing for intangible asset under development. In the earlier format, we had only one line item in the balance sheet, intangible asset under development. Lot of money, billions of rupees, crores and crores of rupees are blocked there, but we don't know what is happening. So now we'll get a chance to look inside that the funds are blocked for 1 year, 1 to 2 year, 2 to 3 year, more than 3 year, which are in progress, which have been temporarily suspended. Not only that, you will have to also give the breakup project wise also. So that will give me more idea about where the funds are getting blocked. Okay, for how many years it is getting blocked, what the management is doing to complete that project. If you attend the AGM, now the investors are looking at these numbers and they are asking questions and they are harassing the management. You can't help it. You have taken money, you have to answer the question, otherwise run a private company. Who stops you? Okay. The dangerous clause is this one now. Details relating to Benami property. This is basically you park your black money, okay, in the name of some distant relative or friends. So now give disclosure. I wonder who will give disclosure. I tried to read 1 or 2 balance sheet, nobody has written. They have simply written no Benami property exists. Okay, so I'll do some more research on this item, very interesting. Where any proceeding has been initiated or pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988 and rules made thereunder, the following disclosures will be made. So this is like you park your money somewhere else in the name of some distant friend or relative. So you have to give disclosures. Name, detail of the property. Even if the income tax department was not aware, now they will be aware. ED, okay, CBI, you are inviting them. Amount, details of beneficiary. If the property is in the books, then reference to the item in the balance sheet. But if the property is not in the books, then state the fact and reason. I have seen few balance sheet till now, because this will be the first year when all these disclosures will come, but nobody has said anything about it. Where there are proceeding against the company against the law as an abater of the transaction or as the transfer, then the details should be provided. So all your legal proceeding you have to disclose, nature of proceeding, status of the same and company's view on the same. So what was the purpose of this amendment? This is not a part of this amendment, this is our view. The purpose of this amendment is that now the shareholder will get information about Benami property, whether recorded or not, status, then financial statement impact. Because if they are caught, they will have to pay a lot of fines and penalty. And then management of the company in such case provide for such liability or disclose as contingent liability, because it may invite liabilities. So you may have to make provision for additional tax or additional interest or liabilities which are leviable under the Income Tax Act or under the Benami Transaction Prohibition Act. Then one more important disclosures they have now added. In detail you have to give now. It was there but it was not sufficient. Disclosure on loan and advance given to directors, KMP and related parties. So company's money, and what you have done? Given to directors, given to key management personnel or other related parties. And the related party is defined in Companies Act, not in that Ind AS 24. This Companies Act has a very wide definition of related parties. Then you have to give disclosures which are repayable on demand and without specifying any terms or payment of repayment. Following disclosures will be required. First, who are these borrowers? Promoter, director, KMP or their related parties. Then amount of loan or advance in the nature of loan outstanding, and the last disclosure, percentage to the total loan and advance in the nature of loans. Just by disclosing this, you will invite a lot of queries from the investors, shareholders, bankers, that why you have given money to this particular person. Is there any business reason for that? Shareholder has given money to the company in the hope that company will utilize it for business. That is why we invest in a company. And company is giving loan to the promoter, director, KMP, which is not fair. It is injustice to the shareholder. And you have to give additional disclosure, further details on quantum of lending to the above related party, materiality of balance, that means how significant is that amount, and it will be useful for the financial users of financial statement to understand the exposure of the company to the above entities. And I will tell you, many investor, genuine investor, long-term investor will seriously look at this item and they will not invest. Then relationship with stock of companies. Oh my God, company does not exist, but it is appearing in your books. Means what will happen to that money? Gone. Okay. So this is one again important disclosure requirement, where the company has any transaction with company struck off under section 248 of the Companies Act or section 560 of the Companies Act 1956, it will disclose the following. So first you have to disclose the name of those companies which have been struck off from the list of companies registered in India, and what kind of transactions are outstanding with that. So example, investment in securities of that, receivable, oh my God, payable, shares held by stock of company, they are holding your share, or any other outstanding balance. Then you mention what is the balance and what is the relationship with that company, subsidiary, joint venture, associate, etc., etc. Again, the management's credibility, integrity, business efficiency will be questioned here if you have lot of items under this heading. Is it right? So today we'll take a break here. We'll continue tomorrow.